Hello class, this is Brian from financialtrainingschool.com and welcome to part 1 of BO209, Hedging Strategies, Reducing Losses. So as a prerequisite for this lesson, you should watch GT302, Hedging. Part 1 of this lesson outlines hedging strategies that are to be used when you're already in the trade and you're trying to prevent losses. As such, these hedging strategies only work if you have enough time to enter the required trades to prevent losses. I bring this up because nowadays there are expiry times as short as 10 minutes. So if you're trading 10-minute expiries and the lockout is 5 minutes, this means you only have 5 minutes to enter your trade and to hedge it with a second trade. So ignoring how fast you execute the trade, it's very unlikely for price to move in the appropriate direction to give you the opportunity to hedge yourself inside of 5 minutes. Alternatively, if you enter the trade right before the lockout period, you don't even give yourself any opportunity to hedge yourself at all. Thus, the hedging strategies outlined here are primarily used for the 30-minute, 60-minute, and end-of-day expiries, and occasionally 15-minute expiries work as well. On the next slide, I will illustrate the comparison between 10-minute expiries and 30-minute expiries. So on the left, you'll see the 10-minute expiry time, and on the right, you'll see the 30-minute expiry time. Both have the same support and resistance levels, both start with the same call option, and both have the same 5-minute lockout period. The difference is how much time you have before lockout. The 10-minute only gives you 5 minutes before lockout, and the 30-minute gives you 25 minutes before lockout. As such, the 10-minute expiry doesn't let you place a put due to already being in the lockout period, while the 30-minute expiry does because you still have plenty of time before lockout. Some people might argue that you could place an impulse put here for a hedge in the 10-minute right before lockout, but that's a low probability trade, which is right in the middle of the range. And based on my drawings, it does win, but this doesn't always happen in reality, compared to the 30-minute, which is a put at the high probability zone at your resistance level, such that if price decides to go down and it breaks your support like down here, you still win one. But in this case, it goes back up in the middle and you win both of them. So as you can see, hedging can be very beneficial if you can execute it properly. So moving on to hedging. According to the general public, hedging is bad in some people's eyes because more often than not, you're putting more money into a losing position in hopes to prevent big losses from initial trades. Another issue with hedging is that it's often poorly executed. Thus, most traders would rather just take the loss than to hedge. As I outlined in GT302, I hedge regardless of the situation as long as the opportunity presents itself. Although there are some people who base their strategies off of hedging, don't go into every trade looking to hedge your position. My advice is to use with caution. Hedging is always secondary. All hedging strategies for binding options require you to place opposite direction trades to hedge your initial position. So if you started with a call option, then you'd place a put option to hedge and vice versa. So for those of you trading via price action techniques, then hedging is merely a subset of price action trading. Normally, you would only enter one trade per expiry according to your money management rules as I outlined in BO209. But if the opportunity presents itself, then hedging just allows you to place more than one trade per expiry. Thus, I hedge regardless of being in a winning or losing trade due to being in a high probability zone anyways. But I only hedge up to a point though. I try to maintain a net gain on my open trades if possible, because reduced profits is better than a loss. As far as execution goes, if you follow your risk management rules, then you should be fine. Don't double up or go all in when hedging. Just trade your normal amounts. Doing so will likely put you deeper in the hole than before. When used correctly, hedging strategies reduces losses via increasing the number of trades. Increasing the trade size is dangerous if you don't have the experience to execute it properly, so if you're new, I'd avoid it if I were you. So in the next 3 slides, I'll be going over 3 scenarios where you could possibly use hedging strategies. So for scenario number 1, you are deep in the money. Given the proper PA, i.e. upcoming support resistance levels, you may want to hedge in the opposite direction of your initial trade, in case of a reversal. This becomes an in-the-range trade, and this is the ideal best situation. You've already seen this example from the previous comparison between 10-minute and 30-minute expiries, so this is the exact same one. Basically, you start trading with a call in the beginning, and then as time goes by, price goes up to your resistance level, you place a put, in the event that it could break below your support. Like over here, I drew it purposely like this. It could go down. In the event that it just keeps going down, then at least you win 1 out of 2 instead of losing 0 out of 1. But in this case, it goes back up and then you win both. This is the best situation because if it's inside the range, then you win both. If it's outside, you win 1. So you reduce your losses using this method. For the second scenario, this is when you're near at the money. This rarely happens with me because I'm trading high probability setups anyways, unless something is breaking formation. As I outlined in the price action lessons in BO202, 203, and 204, I'm prepared to lose the first trade and the last trade of every session because you don't know when you enter the markets. Maybe the support resistance level is about to break, either at the beginning or at the end, such that in the event that you're able to spot the break, then you can place an opposite trade near your original entry, and depending on where the price is, you may be in or out of the range. So for this scenario, I have two examples. The left is still in the range, the right is a breakout. So on the left, you start with a call on the bottom here because price reaches your support. So that's your starting trade. It goes up to your resistance, you place a put. This is exactly the same as scenario 1. Now here's a problem. Price for some reason is taking too long to bounce down. So it starts getting choppy near the top. So for this, because there's a time lag, which is a lesson for later on, you may be hesitant for, is price really going down or is it going to go up and break? So you place a backup call. The thing to note here, in order to hedge, you must alternate calls and puts. Otherwise, it's just doubling up. Notice how the first example so far is call, put, call. And then it goes up to resistance again. So now you can place a put if you wanted to. So let's say we place a put. And then eventually price goes back down and then you lose this call, but you win the other three because you win this one because it's above and you win these two because it's below. So in this example, this is hedging because you did call, put, put. If you did call, put without this call here, that would just be doubling up on the puts, which isn't always safe because what if price breaks out, like over here? So for this example, we don't start the position with a call because price never reached the lower support. So as price goes up to the resistance level, you place your first put. But it turns out that price just surges past, so it breaks out. And as I mentioned in the price action lessons, for breakouts, it's best to wait for a pullback. So if the opportunity presents itself and a price pulls back to the old resistance level, which should become support, then you place a call and it goes back up. So that way you win at least 1 out of 2. The last scenario is when you're deep out of the money. In this case, don't bother hedging because it's most likely a low probability trade setup anyways, because now you're chasing. This becomes an out of the range trade. If it lands in between your call and your put, then you're screwed. So in this example, we start with a put. Price goes up, you place a put at the resistance level, it starts to move down, but it doesn't reach all the way to the support. So unlike the previous examples, we can't place a call at the bottom due to missing the level. So in this case, the opportunity does not present itself. So price moves back up, and I'm sure this has happened with a lot of you. It goes back up slowly, and then the last couple minutes, it spikes up. In this case, you could potentially place a second put here, but that's doubling up like I mentioned before. You're not allowed to do that unless you have a call down here, such that it's put, call, put. But in this case, we have nothing down there. So this prevents you from placing a put up here, which is, in the end, it's good because it eventually breaks out. But the point is, you don't really place a call when it spikes up because these are low probability. You only place a call if it pulls back to the resistance level, which happens over here during the lockout. So in this case, the opportunity does not present itself, so you don't hedge yourself and you don't double up. So you take the one loss. Being able to spot the scenario will more often than not save you money because it prevents you from trying to hedge a bad low probability setup. So some final notes before we end off. When possible, always try to hedge with overlapping boundaries, i.e. in the range, versus non-overlapping boundaries, i.e. out of the range. In addition, always follow your money management rules if possible. Don't up your trade size. Always try to keep the same trade size. And try to be conscious of the net gain and losses to gauge how much you're allowed to hedge. And just a note, this net amount only applies to each asset that you're trading. Don't count the overall net of all positions held. So if you have gains on Euro USD, don't use that to hedge your Australian USD losses. The final decision on how to hedge is up to you. Try them out and see if you can incorporate them into your strategy. Hedging for the most part is an intermediate strategy because for the most part it requires some experience to be able to spot the scenarios to hedge appropriately anyways. Because if you hedge in the wrong situations, then you're just going to dig a deeper hole for yourself. As always, my recommended brokers are 24 Option, Bank to Binary, and Trade Rush. Make sure you guys use my links when you sign up so that you can get an hour of free tutoring with me. Full details can be found at ftstutor.com. Hope you guys enjoyed this lesson, and I will see you guys next time.